Hello and welcome to this edition of the video market update from Orbex.com. Once again, the US dollar index failed to sustain its gains at the beginning of last week and ended the week even lower by 0.5%, even after the US jobs report and all of the estimates of a possible rate hike in September. The main reason behind the US dollar failure last week comes on the back of another set of disappointing economic releases, including the PPI and the CPI last week. The core PPI came in far away from the market expectations, declining all the way back to 1.8 from 1.9, despite the fact that the estimates were to even rise further toward 2.1. The same happened also for the the year-over-year PPI, which slowed down to 1.9, down from 2%. Also, the estimates were even to rise toward 2.2%. As for inflation, it also came in slightly less than expected, somewhere also in line with the market estimates. The year-over-year CPI ticked higher toward 1.7, up from 1.6. This was the only one that came in line with the market estimates, while at the same time, estimates were to rise toward 1.8%. But the core inflation stabilized in line with the market estimates at 1.7. Yet, the month-over-month, for both the CPI or the core CPI came in less than expected. With inflation slowing down further, the estimates also for September's rate hike now is below 20%, while December's Fed Fund Futures is pricing in less than 50% chance for a rate hike, which means that the probability for two more rate hikes this year is probably very low. As a result, the Euro-Dollar Index also declined at the end of last week, while the best performing currencies were the Swiss franc and the Japanese yen, but this comes on the back of the geopolitical tension between the US and Korea, or North Korea, in addition also to the new tensions between Venezuela and the US. These tensions was the good news also for metals, including gold and silver. Gold continued to rise all the way to $12.90, nearing its high of this year, while silver posted the biggest one-week increase since the beginning of this year, or exactly since December of this year. With the tensions keeps on rising for the time being, geopolitical tensions or geopolitics will remain the main driver of the market over the next few days and the next few weeks also, and this is why we saw a notable sell-off in most of the global equities throughout last week. Therefore, you'll need to keep an eye on the news over the next few days and next few weeks. On another note, crude oil also, despite of the geopolitical tensions, failed once again to break above its key resistance area last week and closed even the week lower. Brent failed to break above the $53, while the West Texas failed at the $50 mark and closed below the 48.80s. With OPEC keeping also the current policy unchanged, I don't see any kind of notable rally anytime soon. For the next few days also, we will be watching many economic releases ahead from China, US, the UK, Australia, and many others. But to get the list of the data, please visit Orbex.com economic calendar, and we will also keep you updated throughout the week with the latest market update on Orbex.com. This is it for the fundamental part of this video. Now let's have a look at some technical charts and update the levels that we will be watching over the next coming days. Beginning with the US dollar index. As we saw last week, we had another, as I said at the beginning of this video, at the beginning of this week, it was just a little bit of short-term gains, which not even exceeds the 94, almost like 90. The high was like 93.88, and then it collapsed all the way back down to 93. However, we're still looking at the same area for the past 2 weeks, which is the same, 93 and 91.80. This is the support area that held since almost 2015 until today. It was supporting the US dollar all the way during that period. So I'm still thinking for the time being that a break through that area would open up the way for another leg lower. However, technical indicators are still pointing slightly higher, except the RSI, which is 27, probably oversold right now. So for the next few days, if the data did not even support any kind of pullback, the 92.39 would be our next level, which is a 200-week moving average. On the daily chart, if we look at the daily chart is still the same. We're still going just the same lower highs on most of the time frames, not only on the daily chart, but it actually reached the overbought very quickly and then returned all the way back in. If you can see this for the past 3 days on the candles here, is also lower highs, lower highs, lower highs, and lower lows. So that's what keeps the bearish outlook unchanged. For the time being, on the very short term, I'll be looking for a retracement if if we saw any kind of, if we see any kind of like a break above the 93.85 again, that would open the way for another retracement, probably or toward 95. That will be a possibility, and even, but maximum, as I said before, the maximum retracement I'll be looking for is 95.50s, which also is influenced by the 50-day moving average. So keep an eye on this one the next few days. Going forward to our next charts, which is the Kiwi. The Kiwi actually managed to decline all the way down to the first and the second target on the weekly chart, which is the 73.29 and the 72.73, and we saw some sort of a pullback from the same lows, of the resistance area, the former resistance area, which is still kind of a good thing. Technical indicators are still overbought and still pointing lower, which means that there is still a possibility for another leg lower over the next few days. But however, in the next few days, and especially don't forget that the Reserve Bank of New Zealand said that they would like to see more weakness in the Kiwi. So I would still suggest the downside more than the upside, unless the US dollar like continue to crash like further. That would be the only way to push the New Zealand or the Kiwi higher once again. As for the Aussie, it made the same move. It went all the way back to 78.40, which was the former resistance area here, and then now we're like into the support area. 78.40 technical indicators are still overbought. I still believe that we might see more downside, but not to exceed the 77.20s, unless the US dollar index continue to crash further. That will be our like changing point in the next few days. On the daily chart is also oversold and probably like also crossing over to the upside. That's why with the downside risk is very limited for the time being, not to exceed the 77.20. This would be by its best means. Going forward to the euro. The euro also was supported well above the 17.16. 17.16, if we go back into the chart, it was also the former resistance area here back in 2015. It was exactly 17.16, and then the pair went all the way. We U-turned all the way back up to 118, and the closing above 118 is actually very positive for the next few days. And technical indicators are also crossing over to the upside. That's still a possibility for another test toward the 118.66, and also the 119 would be the next level to keep an eye on, because a break above that level that would open the way toward 120. The red is found despite the weakness that we saw over the past few days. It actually finally stabilized above the 29.70s, and also is still supported by the 50-day moving average. We're still below the trend line on the daily chart in a very short term, but on the long term, which is the trend line since March, it is still positive. 130.40, that should be the level to keep an eye on over the next few days, because that would be the level to keep an eye, because a break above that resistance would open the way for another 131, because again we have a very important data over the next few days, even in the UK. Therefore, a break above, again, as I said, a break above this resistance, which is 31, and the 30.40, that would open the way for another spike, probably 31.12, and even 32. That will be the next level to keep an eye on. Japanese yen finally touched all of our entire targets, the one that we were talking about it since the failure to break above the 114. Right now we're at 108.90. Over the weekend it was 109.15, but this is still a possibility for another leg lower, probably toward 108, especially with the current tension across the globe. That would be again the possibility to keep an eye on over the next few days. Gold, finally metals. Gold, again, as I said at the beginning of this video, there's still a possibility to break above the 1295. I'm still looking for 1300 at least, of 1300, but a break above the 1300 would open the way for another rally, probably toward the 1304 and even more than that. But we need a break above this area. This is a very important area. Since the beginning of the year we were trying to break above it, but without any chance. Hopefully this time would not be a triple top. I would like to see a breakout above that resistance. Finally, looking at silver, it proved itself finally. We had the biggest and the best week this year, closing the week above the entire moving averages, 50, 100, and
200. Also on the weekly, we were actually above now the 100-week moving average. The next level to keep an eye on is those two, which is 1732, and also the 1746, which is the 50-week and the 200-week moving average. On the daily chart, as I said, there's still a possibility for another spike all the way up to 1770 this week. This could be a possibility. In addition, also to the 1730, that will be the next level to keep an eye on, because also a break above that low resistance will clear the way for another leg higher.
This is it for the week. Thank you for watching this week's video. Please like and share the video on your social media platform. Also, you can subscribe to Orbex channel to get the latest video once they are out. If you have any questions or comments also, please leave it below under this video on YouTube, and I'll try to get back to it as soon as possible. This is it for the week. I'll see you once again next week. Have a good one.